Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today I'd like to talk to you about how to delay or avoid income taxes on like-kind exchanges. Like-kind exchanges are exchanges of property that meet IRS rules under Code Section 1031. It's also, therefore, sometimes called a Section 1031 exchange. Trading an old work truck for a new one, or trading an apartment building for a rental house are examples. If the rules are met, no gain or loss is reported when the transfer happens. Instead, your basis in the asset is adjusted, and you realize the gain or loss when you eventually sell or dispose of the asset in a non-like-kind exchange. To be able to defer paying taxes into the future, all the following rules must be followed. Property exchanged must be used in a business or held for investment. Personal property, inventory, securities, and several other types of assets don't count. Property must be of a like kind. For example, real estate for real estate or a truck for a truck. Any cash, debt relief, or non-like kind property received in exchange for the property will trigger tax. The traded property must be identified within 45 days of giving up the exchange property, and the new property must be received by the earlier of 180 days or the due date of the owner's tax return with extensions to qualify. A like-kind exchange with a related party, such as a close relative, will not qualify if it's sold by the related party within 2 years. For example, Sam starts her printing business in 1977. Every 5 years, she trades in her old printing press for a new one. She always does business with the same supplier. She always pays cash for the new machine, minus her trade-in credit for the old one. She never receives any cash, and the company never takes over a loan for her. Since she meets the IRS rules, the exchanges qualify under Section 1031, and she does not have to pay any tax on the exchange. It's possible to avoid paying taxes on these exchanges entirely. For example, in 2006, Sam dies. Her printing press is part of her estate and is inherited by her son James. Due to how the inheritance rules work, James will inherit the press tax-free and will be able to sell it with little or no gain or loss. Thus, Sam will have never paid any taxes on her business equipment during her life, and her son will be able to sell it with almost no tax effect. This amounts to completely bypassing a large amount of income tax that would otherwise have been paid over the years. If you're thinking of exchanging some business or investment property and need tax advice, keep in mind the IRS rules for exchanges can be complex. Call the tax experts at AA Accounting to schedule an appointment to discuss your situation today. We have over 60 years of tax and accounting experience. We can help.